The US economy did okay and the Fed delivered on its dots for the first time since the rate liftoff back in 2015. However, as it turns out, the US dollar barely managed to stay good and is on the verge of turning bad. What went wrong for the dollar in 2017? The thing that undermined the dollar was improving global growth that led to monetary tightening by other G10 central banks. The Fed tightening is no longer the only game in town. Looking into 2018, we see the strong dollar uptrend since 2011 has likely peaked. The US dollar could enjoy a bit of a kicker early next year on the passage of tax reform that could add pressure on the Fed to tighten. But the bigger picture remains that the dollar is transiting from good to bad. The euro is set to lead in driving the transition to a gradually weaker dollar over the next few years. We think the euro will remain as the best performing G10 currency in 2018. We see the euro dollar at 124 by the end of next year. The sterling outlook is likely to become more volatile, driven by Brexit headlines and domestic political uncertainties. For non-European G10 currencies such as the yen and the Aussie dollar, 2018 feels like a year for tactical trading rather than big strategic positioning. The outlook for dollar yen is more neutral, stuck within the 107 to 116 range. But we are wary of stronger yen rates by late next year, as policy normalization in places like even Japan could regain focus. Rising global rates and waning tailwinds from accelerating EM growth and commodity prices warns us not to expect strong upside in EM currency spot next year. We look to instead earn carry with vigilance by buying dips rather than chasing rallies in Brazilian real, Indian rupee, and Russian ruble. Amid a drive to deleverage, China's economic growth is set to slow, and we expect the Chinese yuan to moderately depreciate. Prospects of joining the hiking camp has been supportive of low-yielding Asian currencies such as the Korean won and the Malaysian ringgit. However, further local currency appreciation may also lead the central banks to temper their hawkish guidance.